The views and opinions of this program are those of the hosts, guests, and callers. There is substantial risk of loss in trading futures and options, which you should carefully consider prior to trading. Well, we had a much quieter day in the grains and oilseeds on Wednesday after a significant rally out of the three-day weekend. We were a bit lower, maybe some farmers selling, profit-taking, chart resistance potentially. A lot of factors could be at play here. While meantime, strong day in cattle with futures on the live cattle side ringing the bell at $200. So a lot to take a look at here on the program today. Joining us now for a conversation, Mike Zuzolo with Global Commodity Analytics is with us. Mike, good to catch up with you, my friend. And we're a couple days into a new administration and looking at markets that plenty of talking points. Grains were the star on Tuesday and cattle the star on Wednesday. There's no shortage of topics for us to discuss today, Mike.
No, and broad brushing everything since the inauguration and since the weekend weather coming back from the Martin Luther King holiday, Jesse, is we had both of these factors supporting us for the most part to enter into new highs. And I think the cattle picked up on this in a general risk-on mindset with the equities. We noticed that when we came back on Tuesday with limited rainfall, the meal market and the wheat market really kicked into high gear. Very needed, something we've talked about. We wanted to see that this week. Meal, I think, is a great representation of the Argentine weather. And what I mean by that is as long as the meal doesn't break down, I think the Argentine weather is still underpinning us. Wednesday was a little bit different looking trade because the bean oil was down so hard. And we also had talk from President Trump on Tuesday night about Chinese tariffs. And then again on Wednesday. And I think this really kind of put the trade more on edge, and longs took profit in beans more aggressively on Wednesday than they did on Tuesday, because President Trump talked about how in the course of making peace in Ukraine, if Russia-friendly countries who are helping Russia in the war don't support the peace process, he will probably need to sanction them and put tariffs on them. The trade saw that very clearly as China, I think. I certainly felt that way. And I think it's really important for the viewer to understand at this point. We see now what we had talked about maybe a month or two ago. The Trump trade policy and the Trump foreign policy are one and the same. The tariffs, the economic punishment that could be put out towards countries is a clear foreign policy tactic as well to get countries to bend. President Trump, I think, is making it more clear he does not want to go to war. He does not want to have to use our military. He'd rather use economic sanctions and punitive measures that way. So I think it's really important to realize that, hey, this guy means what he says. And this goes back to what he also said on Inauguration Day, and that is maybe 25% tariffs on Mexico and Canada starting February 1. And I think personally, that's why the corn market's been a little bit more trapped than it has been, along with very overbought conditions on the weekly chart, and probably a little bit toppy cash market as well. But I think the corn market's a little bit more in a corner, and it's very necessary still to have that meal and wheat continue to lead us if we're going to go another leg higher.
I want to lean in on some of this with you, and both on the new administration and that policy that you mentioned, but also on the weather in South America. Let's start there, and let's talk Argentina right now. That's kind of been the big concern that we've been talking about for several weeks, and especially when it comes to, I think, about meal. You referenced meal, Mike, and that was still a strong market on Wednesday. So walk us through the weather situation you're seeing, particularly in Argentina right now, and how this is playing into the markets.
I just got fresh data on Wednesday from the Argentine Agricultural Risk Office. And so this is pretty heavy duty, solid information at this point, along with what I'm picking up from my South American colleague, while southern Brazil has been able to receive a lot of rain and has been able, we can put that a little bit more to the bed as far as drought issues in southern Brazil. Argentina is not that way. The Agricultural Risk Office said very bluntly, the yield projections continue to be reduced even after this week. The amount of help and recharging of soil moisture was very limited. And this is because the rains only compensated for extreme heat, Jesse. So very few locales, based upon the Agricultural Risk Office assessment, very few locales, provinces received rains above 50 millimeters. And so if we look at this vegetation health index using the VIR satellite imagery, and we have the triangle, the more precise location of the major and minor growing areas of Argentina's corn production. If you see red, pink, orange, any shade of that, if we go orange or brighter, that means vegetation and health as measured by the satellite imagery is less than 40%. And that means you go below 50, you're starting to increase the probability of production loss. And I'm seeing, and I think others are starting to see what you and I talked about last week, that we've kind of gone beyond the Rubicon. We can't get back yield that we've lost. And I'm in a position right now to say that based upon the models we have right now and the heat coming in, even with a little bit more rain in the 1 to 5 day forecast, I think we're now below a 50 million metric ton crop for corn in Argentina. I think we're comparable to the yields that we saw in 2017 and maybe 2022. Instead of 8 tons per hectare like USDA has us this year, I think we're closer to 5, maybe 6 tons per hectare. And so I'm not going to exclude 48 and maybe a 47 million metric ton crop in another week or two, but I think it's pretty safe analysis right now to say we're below 50, and that should underpin the trade. So what does help explain the break in Wednesday's trade? Was it a little bit wetter forecast for Argentina? Maybe, because it didn't feed the bull. But again, I think it goes back to demand fears via the tariffs and the trade issues kind of returned to grains on Wednesday, as that July corn crossed over $5. And I think it's really important to watch now what President Trump says heading into the 1st of February. So we're on a very strict timeline because February 1st is less than 10 days away.
And I do want to make a comment here as well that I'd heard some rumors on Wednesday about some phytosanitary concerns with China and Brazil. There's been a lot of rain in central and northern Brazil, maybe some quality issues, some delays to harvest and safrita planting. So I know that's another thing as well, Mike, that I'd heard a few rumors about in the trade here on Wednesday that could be at play here in the next several days.
Yeah, and I think this is a very key point to make because that kind of news you could take either friendly or negative. Friendly in a sense that we're going to get the business if it's really science-based, or it's negative because China is looking for a way to get out of the bean market because they're oversupplied and their demand's not good. What I found interesting Wednesday afternoon was Brazil responded to the phytosanitary concerns and said, we do have issues with what we sent them, and we're working to clean that up. So that's a really good underpinning fundamental, I think, Jesse, and I'm really glad you brought it up. In fact, one source said that the Chinese had actually stopped shipments since January 8th coming out of Brazil from one of the elevators or terminals down in that location, and that would help explain why the Chinese were buying our beans in early January. Wasn't just because they wanted to stockpile as much and weren't as fearful of what would happen from President Trump, maybe. So this is a still to be determined situation, but I'd call it a net price positive feature that if Brazil's beans have a tainted phytosanitary condition, maybe we take some of those bushels off the table.
Let's bring in the macro picture too, and I'll pull up a chart you shared with us looking at the dollar versus the Brazilian real. And just to kind of stick with the South American theme real quick, a lot going on in these outside macro markets as well, just in the first several days of the new administration and even before that, Mike.
Yeah, we had a 20-cent range in beans today on Wednesday and a 10-cent range roughly on the corn side of the equation. We did hit the weekly low in the corn of 482.5 in March. That's a key level. I want to watch this very, very closely because this chart suggests the dollar is getting ready to go into that sell signal against the Brazilian real on a monthly basis, something we talked about either the last week or the week before. And both this trend line support is giving way, and the stochastics at the bottom in the white and the orange are starting to promote a divergence to sell. That means a double top in the stochastic lines, and then the crossing over of the white line and the orange line is the sell signal, traditionally speaking and technically speaking. So I think this would be a very interesting dynamic in the next week or so, Jesse, that if the soybean fundamentals aren't that positive, but all of a sudden we continue to see corn and beans gain, is it because of the currency markets? And so this is a key player right now to kind of, show me I'm from Missouri type scenario. If I get a sell signal in the dollar against the real, I'd want to see the beans react to that. I'd want to see the bean prices at Paranagua start to go up in relation to the United States just because of this currency move.
Mike Zuzolo with Global Commodity Analytics is our guest analyst here today on Market Talk. And Mike, sticking with the macro markets here, looking at the U.S. dollar versus the Chinese yuan, and kind of circling it back to the tariff talk as well, and thoughts here. And just, I know U.S. stocks have been pretty friendly since Trump's inauguration. I believe the S&P 500 hit new highs on Wednesday. Just so you're looking at currencies, looking at macros, and thinking about this U.S.-China relationship. I know this is another piece that is going to be very key to watch here in the next several months ahead.
A great way to discuss it and bring this up, Jesse. I got just a couple points to kind of put a fine point on that. Number one is what we saw after President Trump's inauguration was an emergency action to produce domestic fossil fuels rapidly. The trade was not expecting that, I don't think. And also, he is moving aggressively against the EV mandate and also the Green New Deal climate change mandate. That displaces crude oil and copper as our China economy leaders. And so instead of them being, in my analysis, before President Trump took office, leaders to the upside that the wheat should be watching, they could now become leaders to the downside or just not impact us in a favorable manner if the dollar weakens at this point. So that's a real big heads up to everybody that's been following you and I for the past several months / couple years. That crude oil and that copper I'm not going to rely upon as much. There's still good gauges for the Chinese economy, but they're not as good as before inauguration. So that would be point number one. Point number two is this chart, by breaking the trend line in the dollar against the offshore Chinese currency, it would suggest, again, like the real, and we talked about this, how several currencies looked almost identical, technically speaking. You can see how similar this currency looks in terms of this versus the Brazilian currency. We've got that divergence to sell in the stochastics. We've broken the trend line. This chart says to me, the trade is not worried about Chinese tariffs right now. This is now my best gauge for what the Chinese market is expected to give us, or what President Trump could impact us in terms of the Chinese market. So I've elevated this chart to a higher level in my analysis since inauguration.
All right, I got to ask you about the wheat markets, then we got to talk about cattle here today. Looking at wheat, again, a really nice rally there on Tuesday. Your perspective here is wheat. I'll just ask you this. Is wheat potentially resuming its place as the upside leader?
It should be. We have, and I'm going to include the ruble chart with my client and subscribers when I send our audio and video out today to my on my blog. But I think the ruble making a new 4-week high against the U.S. dollar as we came back from the MLK holiday, along with the trade starting to think more about the Southern Plains and Western Corn Belt dryness. That's getting some traction, I think, because of this cold weather. And some of my AI weather models that I purchase, they're suggesting we stay relatively dry unless you get down into Dallas and Houston and maybe the far eastern edge of Oklahoma. But as far as this major hard red wheat belt, it still looks very dry the next 15 to 20 days. And I think the trade's waking up to that. So if these fundamentals, the ruble, the dryness, are combined with what's happening over in the Baltic states, which they're still not looking very good. Remember, back in November, their very poor conditions, essentially, in their winter wheat crop in Russia was almost 40% before they stopped showing what the number was. So they have not come around that much at all in terms of improving, Jesse. So the last thing that we really want to see here to kind of make the wheat the leader again is on the technicals again. And again, I'll show this on tonight to the clients and subscribers. The wheat corn ratio spread has gone from about 60 cents now back up to about 70 cents. and we're up against a downtrending resistance line very similar to the downtrending resistance line on this monthly chart. So this wedge and the wheat corn spread seem very, very similar. I want to see in about 3 weeks from now us talking about how we broke higher and that we're getting towards that, or if not above, $6 in soft red wheat, and can say unequivocally, technically speaking, we've got a breakout.
Well, and one other wheat chart for us to look at too, and this is a July 25 SRW value chart. And I look at this and I see, we've been kind of with that undervalue line for so long here now, Mike, but slowly starting to work at least back to neutral-ish, I would say.
I agree. And this is where we're still at the top end of a trading range. It's been in place since mid-November, but we've got a wedge that did not fulfill itself. It broke down too early on negative fundamentals and that dollar strength against the ruble. So if we're unwinding the ruble or the dollar ruble trade, and we're unwinding the bearish weather and all these things that you and I are talking about, there is no real reason fundamentally we shouldn't be back up into the next level of sideways trade. And that's around that $6 to 640 level, with my overvalue at 645. And it's a very hard to do the value levels right now, because these value levels could change on February 1st, depending on what President Trump is doing and his administration is doing. So I'm very leery about putting out the value levels, but I think it's justified in the wheat because of the world stocks being so tight and these weather issues going on. We just got to have some price targets to go after at the end of the day.
We got to talk cattle. I wish I had a sound effect of a bell ringing here, but live cattle front month futures hitting that $200 mark on the February contract on Wednesday, 200 and a nickel. And I'll start with the monthly live cattle continuation chart, looking at the channel. And Mike, someone made the comment to me earlier this week that we're nearing the 5-year mark in a bull market here in cattle, aren't we?
Well, and it's interesting you bring that up, because if you look at the stochastics at the bottom of this chart, they have been overbought to beat the band above 70-80% on both the fast and the slow since 2022. And so it is way overdue to have a correction. I mean, there's no way to say it other than that. And we are in the ultimate, so to speak, feed the bull cycle right now. And we got it. You said it a minute ago, Jesse, new all-time highs in the S&P 500, new multi-week lows in the dollar index. We've got a lot of tailwinds again coming back from the 3-day weekend, and what President Trump has said is not necessarily hurting us. In fact, if we do put some tariffs on Mexico, are we back to a similar situation as what we faced with the screwworm issue of not getting enough feeder imports into this country on an already tight supply? And we say this ahead of Friday's cattle and feed report, but the one thing that I like to do on the charts when we make all-time highs, I think you have to have some objectives. They're not set in stone by any stretch of the imagination, but there is something called a swing objective. And if you look at the two white lines on this chart, the little hash marks, that first hash mark is from August of 2023, the low of 162.20. The second hash mark is up at the high from June of 2024 of 195.65. If you take the difference of those two, you're talking about 33.50 in movement up off of a low. If I take that 33.50 and plug it into the September 24 low, that's the last big low we made that took us a little bit below the bottom channel line. That would be a projection. That's 173.78 low from September of last year. Adding to that 33.45, 33.50, you're getting up above 207. So 205, 207 would be my swing objective in front end fat cattle. We get into that area, I think I'd be foolish not to get some puts bought, because keep in mind, USDA is now at 196 or 197 for Q2 in terms of their expectations for price. So we are way high right now in the April futures compared to where the USDA is at in terms of the 194. I'm looking at it right now in terms of their 5-area direct steer price.
Absolutely. We got an on-feed report Friday. We got the inventory report at the end of the month too. And one last chart, feeder cattle. I mean, this market continues to be red hot as well here, Mike.
Yeah, this is a really good chart because I love this chart. It's hard to make because it costs a lot of money to make it. But I love the fact that we're still in a buy signal on an annual basis on those stochastics. So if somebody came to me and said, other than just for profit on the feedlots and cow calf people, when do I want to hedge? And I think as soon as that annual chart sees a crossover in terms of a sell signal, take it at face value and get the pricing done and get some shorts in place is what I'm thinking right now.
Mike, excellent stuff. Final thoughts. We covered a lot today. Anything else you'd mention or reiterate to folks here on the show?
July D's corn spread, July Nov bean spread, they gave up today on the trade on Wednesday. That's something to very much watch, as are those currency moves. As long as the dollar stays weak against our major trading partners, I think we can keep the weather in the market and keep us firming in terms of price action. But I have said to clients for several weeks now, both cattle clients and now corn clients, by the time we get to the 1st of February, we really got to get some floors in place because President Trump's doing what he said he would do. Take him at face value that we're going to get some tariffs. Do it for your farm and do it for your ranch.
Folks want to reach out and have a conversation with you, take a look at your analysis and more. I know they can do it all easily with a phone call or online. How can folks get in touch with you, Mike?
Globalcomresearch.com is the best way, Jesse, and it's 2 M's, globalcom with 2 M's, research.com. Sign up for a 2-week free trial or just give me a call on the toll-free line. You can find that on the website as well.
Mike Zuzolo with Global Commodity Analytics. Great to catch up with you this week, my friend. Thanks for the awesome insight, and have a good one. We'll talk to you next week.
Thanks, Jesse. You too, buddy.
Make sure to subscribe to the Market Talk YouTube channel. You can watch our latest interviews with top market analysts in the country, find bonus content, and much more. It's easy. Just go to youtube.com/@MarketTalkAg and hit the subscribe button. Or you can search for Market Talk Ag on YouTube.